Welcome to today's call, second quarter market update. This is JC Smalley. I have to offer the following regulatory disclosures. This new capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. And so with that, I am actually going to turn it over to Leonard for his presentation.
Okay, thank you very much, JC, and good afternoon to everybody. I hope you are enjoying the incredible weather that we are having and have been having, and I don't know, we'll see if it continues through August. I have a feeling that past performance of Houston weather in the past few weeks does not imply future weather, and that pretty soon we're going to get summer upon us. But until then, it's been terrific. The markets have been a little bit more mixed than the weather has been in Houston, and we're going to be talking about that. Just one thing I want to mention on a housekeeping note: we are currently at New Capital in the process of changing our account authorization access from what is known as level 2, which is the most permissive level, to level 1. We're doing that for regulatory reasons, and you may be getting in the mail or through your email some notices from Fidelity about that we're changing authorization level again from 2 to 1. So if you get that, you don't need to worry about it. There's nothing you need to do, and there's nothing that we can't do for you that we've been doing, and there's no privilege that we then have that we haven't had. It's just downgrading our status, which is going to frankly have some benefits with the Securities and Exchange Commission. So if there are any questions about that, give JC an email or a call. But just to give you a heads up about that. Okay, we're going to do two things today, just like we did in our call in last quarter, and this is the third time we've done these conference calls, and people seem to really like them, so we're going to keep doing them. And we're going to keep the same format that we did in the last call, which is I'm going to review the past quarter's performance because it's informative, and then Todd's going to do some talking about more forward-looking types of information, where markets are currently valued and things that are more suggestive of what we might see in the future rather than the past. And before I get to the quarterly market review, one thing that we have been doing with many clients is moving them toward our model portfolios. We've done a lot of talking at conferences and letters and so on about our move to create model portfolios and to manage portfolios to model portfolios. And we're not doing it with everybody, we're doing it with many. And so obviously we want to track what our performance is. And so here is what the first quarter of model portfolio performance was. And so you can see that portfolio 1 right here, all the way to portfolio 8. And portfolio 1 is the least aggressive of the portfolios, and portfolio 8 is the most aggressive. Portfolio 1 is 25% stocks, 75% bonds, and portfolio 8 is 95% stocks and 5% bonds. And one thing we can see is that all the portfolios were in red for the quarter. 31 basis points or 0.31%. Model 1, the least aggressive of the portfolios, and the most aggressive of the portfolios, 0.87. So not too much separating the portfolios. And already you, just looking at these, you can get a flavor for what the performance in the first quarter was. It was slightly negative for all portfolios. We did, however, outperform our benchmarks. And this is the benchmark that we're in this column that we're using, and the difference here is in this column right here, and you can see that in all cases we performed better than the benchmarks, with the exception of the last portfolio, portfolio 8, which had slight underperformance. And so as you can see from this, the portfolios that were heavier in fixed income and in bonds had a greater outperformance than those portfolios that had a greater allocation to stocks. And what that implies and means is that our bond portfolios had better performance versus their benchmarks than the stock portfolios did. And so we're happy to see that, because we've been doing a lot of work lately in the fixed income portfolios, adding diversification and adding some different kinds of bonds and bond funds that we think can provide some benefit as we face a new interest rate environment. And so we're happy to see that, even though the quarter overall was negative, both for the benchmark and for the portfolios. And of course, this is what most portfolios around the world experienced in the first quarter, with a tremendous amount of volatility. Okay, with that, I'm going to go into these more detailed slides of the first quarter. And so quarter one market review, first quarter of 2018. And this is a piece that we have been including also in your quarterly reports. So if you log into Morningstar and get your quarterly performance reports, this very presentation that I'm about to go through is also something that we're giving to you on a quarterly basis. But I think it'll obviously bear some benefit to go through it. And so we can see the U.S. stock market was down about 0.64% for the quarter. International stocks, which had performed really, really strongly, minus 0.204, and emerging markets up 1.42%. So we're continuing to see strong outperformance from emerging market stocks in the first quarter. And global real estate had a very, very poor quarter. Minus 0.579% was the performance of global real estate. And that was driven not so much by the global portion of it as much as by the U.S. portion of it. U.S. real estate companies had a very, very rough quarter, and we'll go into the details of that in a second. U.S. bond market was down 1.46%. So the U.S. bond market was down actually more than the U.S. stock market in the first quarter. 1.46% for the U.S. bond market, down to 0.64% down for the U.S. stock market. And the global bond market actually had positive performance of 0.94%. So international diversification provided some benefits over the quarter in the way of global bonds and in the way of emerging market stocks. But of course, the picture was mixed. International developed stocks down 2%, and global real estate also was down, but that was driven mostly by the performance of poor performance of U.S. real estate performers. This was the quarter, and you can see that the general trend in the quarter was down. And here are all the different events that occurred. Let's see, oil prices, new 3-year high on growth. U.S. imposes new tariffs, right? So that's been much in the news. Inflation starts to make a comeback. China's economy grows faster than expected. And so these are some of the headlines that occurred over the quarter. And then this is the picture over the past year. And so we had very strong world stock market performance over the past year going into the beginning of 2018. And the picture lately has been much different, as we can see. We've seen a fall off in the markets after this very, very steady and relatively unvolatile climb. You can see that no big drops or anything like that here over this, and this is something that Todd and I have commented on quite a bit over the last year. Every time that we've met with you and talked with you on these conference calls, we noted the lack of volatility that had occurred, but whammo, of course, the picture here in 2018 has been very different. In world asset classes, well, let's see. Here is the emerging market stocks up here at the top, and they were the best performers. A lot of people didn't want to own emerging market stocks for a long time, but a globally diversified portfolio will own them. And this past quarter, we can see why that's a good idea. Emerging market stocks are being driven by a number of things: higher growth rates in those countries, better valuations, and we're also seeing them perform well in light of a pickup in commodity prices, which has been going on. Oil prices and some others have picked up, and very often emerging market stocks in emerging market countries do well when commodity prices firm up, because many of their economies are based on commodity types of businesses. And then here at the bottom, we can see the minus 7%, really closer to 7.5%, that U.S. commercial real estate turned in. So very, very weak performance. I mean, you can see all these weak performers, and then off the charts underperformance by United States commercial real estate. And I don't know, Todd may address that a little bit later, maybe not, but I think that's mostly related to high valuations that got into those companies, and then the rise in interest rates. These are very, very interest rate sensitive stocks, real estate is, because so much of their financing comes through debt. And as a result, as we began to get a fairly substantial rise in interest rates at the beginning of the year, these particular stocks, REITs, fell off the pace. Having said that, of course, they've been very, very strong performers really for decades now. And we have reduced our exposure to real estate investment trusts over the past few months, but we haven't eliminated it. U.S. stocks for the quarter, we can see that the U.S. stocks account for 52% of global stock market capitalization. And so you shouldn't hold 100% of your money in U.S. stocks, because they only account for about half of the global stock market capitalization. And in the first quarter, we actually had positive performance from growth stocks. So we continue to see strong performance by growth stocks, but that started to turn around in March. Facebook, with the troubles that it's been having, there have been some concerns about valuation with Netflix, and even Amazon had some difficulty in the quarter when the President of the United States decided that he was going to start to take on the deal that Amazon has with the United States Post Office, and so their stock suffered. Value stocks had a negative quarter. Our portfolios tilt value. It's not only value, but they tilt value, and so that did have some negative impact on our portfolios in the quarter. And we'll see what happens with leadership and value and growth, because it changes. It can sometimes be growth stocks that outperform, and it can be value stocks that outperform, and nobody really knows when that's going to happen. Over the long term, value stocks have provided greater outperformance than growth stocks have, but in the past quarter that wasn't the case. International developed stocks account for 36% of the global stock market capitalization, and so this is the reason that we include international stocks in your portfolios in very substantial quantity, because that's how the market values those stocks as well. And we can see that internationally, it was a down quarter for all types of international stocks, whether they were small, whether they were growth stocks, whether they were large, or whether they were just plain value. It was a negative quarter. You can see red across the board here for international stocks. And again, I note that international stocks have performed very, very well. In fact, in calendar year 2017 last year, they outperformed the United States stocks by about 10%, although quite a bit of that was based upon currency issues and the depreciation of the dollar last year. Emerging market stocks were the one lone bright spot of all the three major asset classes. 12% of the global stock market capitalization is emerging market stocks, and with the exception of small cap stocks, everything was positive. Whether it was value, large cap, or growth stocks, all had a positive quarter in emerging market stocks. Select country performance. Well, I'm sure you all know that the very best performer over the quarter in developed markets, you all know what that is. That's Finland, right? I'm sure you all were going to get that. And the worst performer, our friends north of the border, Canada. Canadian stock markets were down about 7.5%. Australia down almost 6%. Switzerland down 4%. Again, back up to the top. Italy up almost 5%. Singapore up 3%. And I'm sure that going into the first quarter, everybody out there, you were betting that this is exactly how it was going to turn out. On the emerging side of the equation, Egypt was the best performer. Almost 13% performance by the Egyptian stock market. What is that? I can't read it very well. Brazil, 11.5%. You may remember Brazil was really struggling in a recession for many years, and we're seeing very strong performance out of Brazil. Peru, what's that after that? Russia. Russia is having a very strong performance in the stock market right now, given the strength in oil. And down at the bottom of the list, Philippines down -10. Poland, which led the way last year, the strongest performer in 2017, now is the worst performer, and India also down. So we never know when these countries are going to perform strong or weak, but I always think it's interesting to take a look. Performance of currencies versus the U.S. dollar. The Japanese yen strengthened. The Norwegian kroner strengthened. The British pound strengthened versus the U.S. dollar. The Canadian dollar, Swedish krona, and the Australian dollar, all down here at the bottom, weakened versus the U.S. dollar. And in emerging markets, we can see, what is that first one there? I'm sorry. Oh, the Mexican peso. I'm sorry. I don't have my reading glasses on, which I probably should, so JC and Todd are helping me here. But the Mexican peso appreciated 7% in the quarter versus the U.S. dollar. And you may remember coming out of the election in 2016 that the Mexican peso just plummeted. Great concerns that Mexico was going to really suffer under the Trump administration and potential trade frictions related to NAFTA. In fact, the Mexican peso has done very well after that initial fall off. And I think the other day the news was that Mexico has just concluded its own trade pact with Europe and the European Union. It said we're gonna go ahead and make this trade pact on our own and go it alone, and that's a lot of what we're seeing these days. And again, it's another reason why international diversification makes a lot of sense, because if trade pacts between the United States and Mexico come undone, there's nothing to say that Mexico won't undertake its own actions to create trade alliances with others in the world. Here is real estate investment trusts. As I mentioned, it was a very tough quarter for real estate investment trusts. 56% of real estate investments are in the United States and 44% outside. And even though the U.S. was down 7.5% in their real estate investment trusts, much better performance, although it was still negative, with global REITs. And we invest your money internationally also in real estate investment trusts. One of the funds that we like to hold is the DFA Global Real Estate Fund. And so you can see that this fund would have helped you stave off some of the very bad performance in the U.S.-only real estate sector. You would have still had a negative return, but it would have been somewhere in the middle of this rather than all this big loss in the U.S. It would have been helped by the lower 1% loss in real estate investment trusts. Nobody likes to lose money, but sometimes it happens, and if we can dampen those losses, then that's better. Commodities have actually performed pretty well recently, and that's been led by a revival in the price of oil, which you can see here came in around 8%. The very best performer, I know all you out there in the soybean country, right, are buying soybean futures, 20% up in soybean futures. And I don't know what that's related to. I'm guessing it's related to some of the tariff issues that that are going on right now, because U.S. farmers are possibly facing some issues related to soybean exports to China. Although I don't know why the price would be up. You'd think it would be down, but it's up. So I don't have an answer for that. And all you sugarholics out there, you should be jumping for joy because the price of sugar dropped 20% in the first quarter. Okay, fixed income. You may have been hearing about a flattening yield curve, and you can see that these yield curves are flattening to the point where bonds that are shorter term have essentially the same or close to the same yield as bonds that are longer term. And so you're not getting paid very much to hold longer term bonds versus shorter term bonds. And so I think, Todd, you're going to talk more about interest rates perhaps in your section of it. One of the things that we continue to watch is whether yield curves go like that and get inverted, and we start to see higher interest rates for shorter term bonds than for longer term bonds. One of the big concerns is that that can indicate or be some kind of leading indicator of recession. And even though there is very little, if really almost no sign of recession out there on the horizon right now, given the strength in the global economy, almost all market professionals watch the yield curve because the bond market can lead other markets in its ability to make predictions. The bond markets are very, very big and very mathematically oriented because returns are already dialed into bonds from a coupon standpoint. And so the yield curve is something that's watched very closely, and we watch it very closely as well. Impact of diversification. I'm going to skip this slide. Basically, it just shows that the more stocks you held over the long term, I guess I'm not skipping it, but the more stocks that you hold over the long term, the higher the return has been. And so that's it for my presentation. So without any further ado, I'm going to turn the microphone and the control over to Todd for his presentation. Okay, Todd, take it away.
Thank you, Leonard, and good afternoon, everyone. And so much like we did the last few calls, we are going to present some slides on a few things that we watch very closely, that we think give us a lens into the market environment. And as we manage our portfolios and manage your portfolios, we want to make sure that we're on top of current events, on top of valuations, on top of what's going on in the markets, so that we provide the best experience and best returns to you that we can. So basically, we'll start with just an economic picture of the global economy, and that'll be a slide that if you've been on these calls before, you've seen, and I think Leonard likes to call it my favorite slide, which it definitely is, and something that we pay close attention to. Then we'll talk a little bit about equity valuations, both in the U.S. and international. We'll talk a little bit about the fixed income market. As Leonard alluded to, we're seeing interest rates rise, and there are certain implications to that we want to be ahead of, and that we want to make sure that we're positioned appropriately for. And then lastly, just a historical perspective of the recent market volatility. As Leonard had shown that slide on the DFA presentation, we didn't see much volatility for really 18 months going into January. And I think if you read our note, our monthly newsletter, we talked a little bit about some of the stats, and it's amazing that the U.S. stock market usually sees a dip of, I think it was 5 dips of 5% or more, and 1 dip of 10% or more in any given year. And we, for 18 whole months, we didn't see. I think we saw 1 dip of close to 5%, and that was it. So volatility came back, and it came back with a vengeance. But historically, when you put it in perspective, it is somewhat normal, though it's not so normal to see it in such a consolidated period. But nonetheless, the volatility that we're seeing in the markets is somewhat expected, and something we should, I don't want to say embrace as being the best term, but realize it could be here for some time going forward. And that's also pretty symptomatic of late cycle, which we are definitely in the later cycles of a bull market. So starting with the global economy, and this is the slide I was alluding to, it's very colorful. And you may notice it looks a little different, and that's because this is provided by JP Morgan. And historically, they show the numbers, so all the different numbers for the different periods. And now you notice they're only showing the numbers for February and March, and that was because they ran into a copyright issue with the producer of the index, and they said someone caught wind of it and said you can't show those prior numbers without paying a fee or whatever it is. And they said, can we show the first 2 months? So that's why they're now showing the first 2 months. But nonetheless, what's important here is the numbers. I'll get to it in a minute, but it's really the colors. Green is good, red is bad. And we can see that going back to 2008, the global economy, as indicated by this metric, which is again the Global Purchasing Managers Index, which is a survey of a global survey of all the purchasing managers for different corporations, and they're asked every month what they think the forthcoming months of orders will be. And when they're optimistic, they register a score of above 50, and if they're pessimistic, they register a score of below 50. So anything above 50 indicates growth, and this is actually a pretty powerful leading indicator of economic growth. And so going back to what Leonard had circled, you can see in 2008, the global manufacturing market was very pessimistic on the outlook of earnings and of growth. And we can see that as the market bottomed, you can see that growth actually, or optimism started to creep in. And the markets did very, very well up until the European financial debt crisis. And that was the summer of 2011 when that started. You can see that for the most part, in the developed world, in the U.S., which is the top, the U.S. actually said, things look pretty good. But in Europe, they were starting to feel a bit worried. And their scores came in below 50 and were in the red. And then we get past 2013 and we start to see the beginnings of a coordinated growth story. And this is what's been talked about in the press, is that really from 2014 on, we've seen a coordinated global growth story, a coordinated effort, and a very, very powerful, robust growth engine across the global economy. So not just the U.S., but the developed markets, and actually when you look at down here in the emerging markets, even they started looking green, getting more green in the more recent periods. But I do want to point out a couple things. February numbers are listed here, and you can see, and we'll just look at the U.S. for a second. The U.S., the number was 55.3, and then in March it was 55.6. So actually it slightly increased. But if you look at the preponderance of these numbers, they actually started to roll over a little bit. And so the thought is that the March numbers were starting to pick up more about the worries of the tariffs and the disruption of global trade. And what could be more of a hindrance to a coordinated global growth effort than taxes on imports and exports and tariffs? And so it's not a glaring concern, but it does show us that, hey, you know what? As those things started to come out, the market started to take wind of that, and we saw that reflected in the numbers. So the numbers did roll over a bit, but nonetheless, still way above 50 and still on the positive side for global growth. So moving forward and looking at valuations, this is a chart of the S&P 500 and looking at the PE ratio of what we call the forward PE ratio, basically the price of the stock divided by the predicted earnings of the stock. And so you can see here, this goes back all the way to 1990. And we have three lines drawn here, which was one standard deviation above the average of 19.3 times earnings. 16.1 is the historical average of the last 25 years, and minus one standard deviation below that is 12.9 times. So anything down here is considered cheap. Anything up here is considered expensive, and in the middle here is kind of average, if you will. And so if you remember back to our call at the beginning of the first quarter, the market was up here. And we were saying that the market was actually somewhat expensive and getting close to this one standard deviation line, which is a pretty important level that the market watches very closely. And then with the increased volatility that we saw in the markets, we saw PE ratios drop. Now, part of that is driven by price. And as Leonard showed, the S&P 500 was down on the quarter. And so therefore, the numerator in this ratio went down, and that would have an effect of driving it down. But what really happened was the earnings. And so the earnings, we'll see on the next slide, actually, the E in this equation actually really increased dramatically. and that goes back to the tax cuts. And so once the tax cuts went into effect, the market started to anticipate a much more robust earnings growth picture for U.S. equities. And as a result of that, the PE ratio, earnings estimates increased faster than price. And so again, going back to the quarter, as markets were falling, the earnings estimates were rising faster in a falling stock market. So it's not unexpected to see a dramatic drop like this. But nonetheless, what does this put us? Basically, it puts the S&P 500 or U.S. equities back to somewhat of a fair value as long as the earnings estimates that we project are hold true. It looks like U.S. stocks are actually better valued at this point than they were 3 months ago. You can also see that up here, which is this table that we show, and it kind of just shows a comparison of a couple of different metrics, the 25-year average here, the latest print here, and then whether it's over or undervalued, again, using the standard deviation metric. And these numbers also improved quite a bit from the beginning of the quarter, again, for the same reasons. So going back to earnings, here's what the earnings picture looks like. And so this slide, this graph here on the left, the green bars are actually what the market predicts earnings to be for the S&P 500 over the next 4 quarters. You can see fourth quarter 2017 came in at $33.86, and we're expecting the first quarter earnings, which we're seeing right now, come through. We're in the height of earnings season. It's projected to be a little bit higher than that, but look at the growth they're expecting. They're really expecting a robust jump here for the second quarter. And so if this holds true, that's going to be very positive for stocks. And then a couple things that are helping, tax cut being one big driver of this estimate. But another thing that we talked about before is the dollar, and the fact that the dollar has been weaker, and the anticipation of the dollar should continue to weaken. And if that holds true as well, that's going to be very positive, because this box up here shows S&P 500 companies and the proportion of the revenues that come from U.S. versus international. So if 43% of revenues of the S&P 500 companies are coming from overseas, and they're generating those revenues in a foreign currency, and the dollar drops in value, when they translate that money back to U.S. dollars, it comes a higher profit. And so therefore that feeds into the earnings picture as well. So in a nutshell, as we look at U.S. equities, prior to 3 months before, we're actually somewhat neutral on them at this point. We think that the valuations look relatively better than they did before. And if the earnings do hold true, we think that'll make its way into higher equity prices. I will caution this though, and this is something that others have talked about. The tax cut was a temporary kind of a jolt of a stimulus into the markets. And what this chart doesn't show is what do profits look like in 2019 and beyond. And the market is much more pessimistic that the tax cuts and the infusion will hold true, and that earnings can grow at this pace into 2019 and beyond. So I think it's safe to say we want to enjoy the ride while we can here in 2018, but 2019 could be a different story. Now, a lot can change between now and then, but it's something we're watching pretty closely, because if earnings do roll over, we would expect the equity markets to kind of follow suit. So it's something to be cautious of. But right now, there's a bit of a tailwind that I don't think you don't want to fight too much in your portfolios. Moving on to the international scene, and this is again a slide that we've shown many times. And again, this just highlights what's happened between the U.S. markets and international markets going back to 1997. International markets are in purple. The U.S. markets are in gray. And you'll see that they traded in close tandem to each other from 1997 to right to the bottom of the market in 2009. And then as they started to recover, you'll see the divergence. And this is that European on the very first chart, right? This is where there was worry about the European Union, worry about the euro. This is where Greece may default and what that might do to the European economy. And the U.S. market enjoyed a very robust growth rate, and the international markets went sideways. And so this is a divergence where many, many market participants believe that these lines will converge. And I think we're in that camp. And I think there's a lot of statistics that support that, mainly valuations. So again, looking at the U.S. This is the S&P 500. The PE ratio again at 16.4. The All Country World Index minus the United States, this is everybody but the U.S., is trading at 13.3 times. And if you look at the average PE ratio, you're looking here at the average at 14.5. So actually, these are trading cheap, below the average. And the U.S., I said before, is trading pretty close to the average. Also, from a dividend perspective, you're getting much higher dividend yields internationally, and they're trading much higher than their 20-year average as well. And so this, again, makes the case and supports our view that over the long term, we want to be exposed to the international markets. We think that there's more value to be had there. This is just another picture showing earnings, much like we showed earnings in the U.S. This is showing earnings internationally, and there's a couple things I want to point out. It's kind of a busy slide, and I drew some arrows here just to kind of draw your attention. But this is really what the market's looking at. If you look at what the U.S. and Japan have done, really since this point here, earnings have really, really risen dramatically in both the U.S. and Japan, and so much so that they've actually exceeded the pre-highs going back to 2000 and 2007. That has not happened in the emerging markets, nor has it happened in Europe. So even though the earnings have been increasing quite a bit, there's still room to grow because they haven't even eclipsed their previous highs. And so that lends itself again to tell us to say, hey, you know what? There's a little more room for this market to move. The markets are aware of this, so obviously what we're saying here is not unknown by market participants, and so capital is going to flow to the highest returning asset, and the market right now is looking at this information, saying, hey, you know what? International markets look like they could be a good place to be going forward. So moving on to the bond market, and Leonard had shown the yield curve, right? And so the yield curve is a very, very important metric that everyone watches, right? And can, as Leonard alluded to, can be a precursor to potentially a recession when a yield curve inverts. But I want to make sure we're clear that a flat yield curve does not always indicate an inverted yield curve. And actually, a flat yield curve is very typical of a late cycle market where you find the Federal Reserve starts to tighten policy, and they tighten the front of the curve, and so the front of the curve starts to move up. And so that's very normal. So a flat yield curve in and of itself is not an issue. It's when it inverts is really where the problems can arise. But what's happening, we're in a unique situation here, though, in that we haven't been in a bond market like this in some time where interest rates are very, very low, and they're set to rise. And what we're seeing in the dynamics of the bond market, and what this chart is showing us, is looking at the Bloomberg Barclays U.S. Aggregate Bond Index. This is an index of the U.S. bond market, and a very, very highly followed index. And the blue line here is showing us the yields of that index, and the gray line shows us the duration of the index. And so what the duration is, it's a way we measure interest rate sensitivity. And so as interest rates rise, bond prices fall. And duration tells us the effects of the sensitivity that a bond has to that rising interest rate. The higher the number, the more sensitive a bond is. And what we're seeing, and we haven't seen a divergence like this in a long time, definitely not on this chart, is that durations have been rising dramatically and yields have been falling. So basically, the way that investors are situated at this point is investors are getting a low yield, and they're taking a lot of interest rate risk to get that yield. And that can make for a very painful ride if interest rates really start to rise. And so Leonard had alluded to at the beginning of the call about our bond portfolio, about our model portfolios, and particularly our bond portfolios. And so we spent a lot of time looking at this, and actually going into the first of the year, we decided to look at how do we position our bond portfolios to lessen this blow. And so what we had done is that, one, we try to lower our duration of our portfolios. And so the bond portfolios that we manage, our aggregate duration is about 4 versus the benchmark that we saw, which is closer to 6. So we're taking a little less interest rate sensitivity in aggregate when you look at the entire bond portfolio. Also, what we did was we added more credit instruments, things like floating rate bonds and high yield bonds. And so what this chart here shows us is the impact of a 1% rise in interest rates. So this is getting at the heart of what I was explaining about duration. And the longer durations, the 30-year bonds, have a very long duration, and you can see that they're very sensitive to a rise at a 1% interest rate. So you can see the price return. If interest rates go up by 1%, the 30-year Treasury will drop in value by 17.3. Total return, 14.3. That's just a difference of the interest payment. You can see here, if you have a longer duration and interest rates rise, you will experience a sharper decline. Versus if you go up here, the 2-year Treasury note, actually, if interest rates rise 1% and you're in a 2-year bond, your price drops 1.9, but you actually have a positive return of 0.3 because the interest rate, the interest payment you get offsets that interest rate risk. Down here, when we get into more credit sensitive instruments, you can see that actually they have positive total returns and emphatic positive total returns when rates rise. And that's because they're less sensitive to interest rate risk and they're more sensitive to other economic factors. And so when we build our bond portfolios, we have a mix of credit and interest rate sensitive instruments to create to create a portfolio that we believe will provide some protection against rising rates, provide yield in the form of interest payments, and then also be somewhat defensive, so more active managers or active strategies to be more defensive that can move within these strategies here to better position their portfolios. All right, and the last thing we want to talk about, the last few slides here, is the market environment. And we showed this slide last quarter, and I think it's important to show again. I wouldn't be surprised if we continue to show this as we experience volatility. There's a couple things going on here. If you look at the top box here, this green box, you can see that this is the market returns going back to 1980. And 75% of the returns, annual returns since 1980, have been positive, right? And if you actually go back to 1980 and think about all of the volatility and different events that we've experienced, right? It hasn't been just an easy, smooth ride all the way to the top. We had 87, you had the mid-90s, we had 2000s, obviously 2008, and actually since 2008, if you actually look at the market, we haven't experienced much from negative returns for some time, as we talked about before. But what's important to understand is that the average inter-year decline since 1980 is almost 14%. What that means is that on average, in the calendar year, the S&P 500 has actually declined about 14% at some point in total. And so right now, if you think about where we are today, we're down 10%. That was the intra-year decline that we experienced in 2018. So as I get back to it, it doesn't feel normal, but if 2018 ends here and this is as low as we go, we would look back and say 2018 was actually a normal year, which right now again may not feel that way. But nonetheless, the market's volatile, and you need to embrace that. And how do we defend against that? We defend against that with diversification, right? And diversify a very, very diversified portfolio, both in your equities. We're using U.S. equities, international equities, and international REITs and things like that Leonard had talked about, as well as your bond portfolio that we talked about on the previous slide. So as we look at the markets, and this is and the prospects of a bear market. And so this is a slide that Leonard and I had looked at, and it's one that's been in the JP Morgan deck for some time, but it's starting to get a lot more face time, as you can imagine, as the market's starting to get a little more volatile. And this is looking at, okay, well, let's look at the past bear markets. And bear market is any market decline of 20% or more is considered a bear market. And what JP Morgan has done on this slide, again, it's very busy, but here are the events that have happened. So they were looking at 10 different events, including our most current cycle. And it tells us when the market peaked, what the return during the bear market was, the duration, how long that bear market lasted. I'll jump over this box for a second. When the bull market began, what the bull market return was, and how long that bull market lasted for. So one thing you'll see is that the bull market has always outpaced the bear market. Once it's been over, you actually made a lot more money in the bull market. The other thing is that typically the bull markets have been longer in duration than the bear market. So that's not always the case, but that's typically what's happened. But as we try to get into predicting what may happen and how do we want to stay ahead of this, I think this is a pretty helpful table to look at. And what JP Morgan has pointed out is that these four factors are most often prevalent when we see a bear market. So the number one is recession, right? And you'll see that almost every recession almost every bear market that we've been in has been associated with a recession. Another one is commodity spikes. And you can see that not all the time, but sometimes. Here we see it in the, I think that's 68 to 1980. So remember the 70s, right? We saw a lot of commodity spikes, spikes in commodities that had pressure on earnings, pressure on the markets, and were part of the bear markets that we experienced then. Another is an aggressive Fed. This is the Federal Reserve being very aggressive, raising interest rates. And you can almost say that when the Fed is very aggressive, the Fed, sometimes you hear the term a Fed-led recession, and that's what that's alluding to. Is the Fed is actually raising rates too fast, and they raise them so fast that they choke off the growth in the economy. And the last is extreme valuations, PE ratios. Yes, how expensive are stocks? And so you can see it's a very busy slide here. Not all of them are prevalent in every bear market. But what's interesting is that when we look at the current environment, none of them are present at this point. And so I think that helps us put a little bit into context of where we are in the cycle. And although we're experiencing a lot of volatility, I think we're hesitant to say and stick a stake in the ground and say, you know what, hey, we've arrived at a bear market. These can change. It can change very fast. But nonetheless, right now, we're not seeing the normal things that we would expect if we were heading into a bear market. And then my last slide here is just an illustration of time and investing. And so all the clients on this call, they come to New Capital for our advice and our guidance. And you've heard Leonard, and you hear me say this often, is that we want long-term investors and be patient. And look at the long term and make sure that your assets that you're investing in are appropriate for your goals, your objectives, and your long-term horizon. And it's very easy for us, and especially in times like this, to look at short-term returns. So what this is showing us is 1 year rolling. This is showing us rolling returns of the S&P 500 going back 1950 to 2017. And so this right here, this is stocks. So what this actually is measuring is saying that if you take 12-month rolling returns from 1950 to 2017, so there's a lot of them, right? It's just a constant rolling return. And then you aggregate that. This is the range of returns. So the best returns of a 1 year period was 47%, and the worst return was down 39%. That's just 100% in stocks. The blue is bonds. And if you do the same thing with bonds, the best 1 year return was 43%, and the worst 1 year return was 8%. There's a whole lot of returns in between. And then if you look at a 50-50 portfolio, 50% stocks and 50% bonds, you can see 33% is the high end and down 15% is the low end. And so this is the benefit of diversification. A diversified portfolio, has a shorter range than the two, and definitely more shorter range than the stocks, which should be expected. But it's over one period, all right? That's over 1 year. But what happens if we stretch that out and we look at 5 year rolling returns? Well, here the picture, these become much shorter in stature, and look at the negative periods. The negative periods of holding a 100% stock portfolio over a 5 year time horizon, the lowest return is minus 3% annualized over that 5 year period. In bonds, it's minus 2%. In the diversified portfolio, it's not negative. It's actually a positive 1%. And as we move out further to 10 years, you can see that the bond portfolio does not have any negative returns, nor does the stock portfolio. The diversified portfolio. The stock portfolio actually only has minus 1%. Majority of the returns are positive. And if we get out 20 years, there are no negative returns at all. And so this just hits home, I think, the idea that it's easy to watch the headlines, it's easy to get spooked and scared at the market volatility that we're experiencing. But if you stay the course and you're disciplined and maintain proper diversification, we're confident over a 5 or 10 year period, you will have a positive experience in your portfolios. And so with that, I'll turn it over to Leonard to close it out, and then we'll take it.
Todd, thank you. Fantastic job. Always interesting for me, and I'm sure for our listeners today as well. So with that, I'm going to turn it back to JC to conclude the conference. I want to thank everybody for taking time today and for joining us, and we will look forward to joining you again, I guess, 1 quarter from now.
Thank you, Leonard, and thank you, Todd. All right, so Bob has a question. Why is the market unenthusiastic on 2019? And I'm going to pass this over to Todd.
Thanks for the question, Bob. So really, this goes back to the growth rate. So maybe I should have, maybe I can clarify that a bit and say the market's less enthusiastic of the growth rate. We're seeing earnings right now grow close to 20%, which is a very, very fast pace. And the idea is that in 2019, earnings are going to face headwinds. The tax return, the tax tailwind will go away, as I alluded to. But additionally, some of the other things we talked about, rising interest rates. So rising interest rates can have a negative effect on margins, as well as potential for rising wages, which would manifest itself in inflation. And so in 2019 and beyond, I think the market does anticipate that interest rates will be higher, and more importantly, that inflation may be higher as well. And so when you couple that with the kind of the after effects of a tax stimulus on top of rising interest rates and increasing wages, that'll put pressure on margins and should be a pressure on earnings. So that is really what the market's looking at. Although I will say this, I don't think anyone's predicting negative earnings in 2019. That would be highly recessionary in many ways, but a much more slowdown in earnings growth. And I think that would manifest itself in prices as well.
Here is one more question we'll take. What does New Capital project as a portfolio gain for 2018? And it's a really good question. And the answer, to echo Todd's last slide, is we don't know. From any year to another year, in any given year, we could get a range of returns that could be strongly positive to strongly negative and all points in between. And that was the point of Todd's last slide, is that if you're looking to be able to make predictions about any given year, you're going to be sorry. And we see this with professionals every single year. Every year you get all sorts of market watchers and gals who go on CNBC and publish letters to their clients and tell them what they expect the returns to be. And we don't do that. We never tell you what we think any particular year's return is going to be, not because, we're dummies, but because it's a very dangerous business to try to make predictions about something that is not stable and volatile like market returns. And so the best prediction we have is for long-term gains in portfolios. About that, we're able to be a little more certain. And so what we think is that diversified portfolios on the conservative side over the next 10 years might earn 4%. On the low side, let's say, 4% on average. And on the high side, more aggressive portfolios might earn 6 to 6.5%, maybe 7. Todd's motioning 8, but we don't think so. I don't think so. Yeah, so 4% on less aggressive portfolios on average over the next decade, up to, let's just say 6%, maybe 7 on the high side, very aggressive, mostly stock portfolios, strongly mostly stock portfolios, on average each year over the next 10 years. But in any given year, we can't tell you what the returns are going to be. In other words, you've got to get those returns over the 10 years, you've got to stay in your seat if you want to get the returns. And in the meantime, if you don't like the ride, then the adjustment we make is in your portfolio to move you toward a less aggressive portfolio stock-wise and a heavier bond allocation. So hopefully that answers the question. Here's a question from Kelly, who is asking, do our Morningstar account summaries show which of the 8 model portfolios we are invested in? And the answer is that we are increasingly, as we work on client portfolios, and the way that works is Todd and I sit down and go through your portfolios in detail together in our conference room, looking at the TV, using a whole range of tools, and it's an intensive process. Todd brings to the meeting the initial draft of the trades we're going to make in the portfolio, and then he and I look at them, and ultimately, once they get approved, he'll place a trade, and then I'll release a trade. We have a two-step process. And increasingly, yes, your Morningstar reports should I say, reflect a benchmark that is the target benchmark for your portfolio. And so we are increasingly moving people over from the old benchmarks to the new benchmarks that are reflective of your risk target. So that does today's quarterly update. We will look forward to being with you again on next quarter's update sometime in the later summer. I hope all of you are having a great spring, and as I said at the beginning, enjoying the weather. Please get out there and enjoy the weather in the outdoors, and have a great afternoon and evening. Take care.